Get ready for more valuable financial insights from Northern California's premier retirement income planners, Ahmad and Jim Files, owners of Peak Financial Freedom Group. For more information, go to peakfin.com. And now, here's Dan and Jim.
We'd like to welcome you to the Peak Financial Freedom Hour. I'm Dan Ahmad here with my partner, Jim Files, and we're so glad you joined us for today. There's going to be a lot of great information for you. For those people within 5 years of retirement or retired, you're going to get a lot of answers to questions that you've probably had for a long time. And we know a lot of people have been listening to us for years, and we talk about the same general information, which is how at retirement, you better be reducing your risk and know how much risk you're taking. You better be knowledgeable of how much fees you're paying and reduce those down. You better know where your incomes are going to come from and make sure a big chunk of that is not going to run out for as long as you live. And you better have a written plan. All those things are what we do. And we love to be able to meet with you to discuss helping you put together a plan that allows you to accomplish all those goals. So make sure, just dial pound 250 on your cell phone and say the keyword money. That's pound 250 on your cell phone and say the keyword money. You can schedule your 100% complimentary consultation, second opinion about your money with us today. Make sure you give us a call. We'd be glad to meet you. We love that you are listening to our show. You can also listen to our previous radio shows on our podcast. You can actually go to our YouTube channel, get a lot of videos on educational portions of retirement planning, as well as watch us actually film the radio recording. You can go to the website, get a lot of data, and download some books. So please do not hesitate to contact us. We'd be glad to answer your questions. And you know what? If ultimately you're tired about worrying about your money and your future, which almost every single American is, and you're ready to work with someone who will listen to you, sit on the same side of the table with you, make recommendations that are in your best interest as fiduciaries and as a certified financial planner, just to give us a call. We'll be glad to sit down with you and help. Jim, why don't you start the day with a really, really good quote of the week, and then we'll get into the meat of the show.
Yeah, here's a great quote. It's going to tie right into what we're going to talk about today on the show here. It says, opportunities are like sunrises. If you wait too long, you miss them. You know, I want to talk, Dan, here immediately about the opportunities that we see right now in the marketplace when it comes to income and income type products, because what we see today, we haven't seen for decades, and it's going to go away because interest rates are going to go down. But we have the ability right now, if you're getting close to retirement or in retirement, to maximize your income sources in retirement with certain types of products. So maybe you can talk about that, Dan.
Well, why don't you start with the big topic of why it's even necessary to talk about what you're saying we need to talk about, because of the Fed lowering interest rates and where bank interest rates are going to go probably over the next several years. And we got used to, first low rates, then we got used to huge rates. Well, what's going to happen now, and how's that going to affect how retirees are looking at using their assets for income?
I think everybody's been educated on the fact that because of high inflation 2.5 years ago, the Fed set out on a mission to raise interest rates, because by raising interest rate, it's slowing the economy down. People aren't going to buy houses as readily. They're not going to buy that new car. They may not take that vacation because interest rates are too high. Well, inflation has come down significantly over the last 2.5 years. The Fed's lowered interest rates 0.5% at the federal funds rate about 3 weeks ago, and they've indicated they're going to lower rates again later this year. They definitely will lower rates as inflation comes under control. And when the new administration takes over in January, the focus is, how do I stimulate the economy? Well, that's lowering interest rates, which means if you have treasury bills, if you have CDs, if you have savings accounts, if you have high yield accounts at internet banks, all those interest rates are going to decline, and they're going to decline significantly over the next 2 years, Dan.
Well, I can remember when they were less than 1%. Yep. I can remember clients coming in probably 6 or 7 years ago, 5 years ago, whenever it was, and they'd show us they'd had $500,000 sitting in the bank earning 0.2%, not 2%, 0.2%, which was that? That's like $1,000 a year of interest for the whole year. And then they got used to it being a lot higher, which made it a lot easier to plan. But now we're dropping again. So we have to now look at those alternatives you're talking about to take advantage, because you always want to look at where the market is and then pick what's best for you. Well, right now, if we can find one of our assets, one of our buckets, the green bucket, which we call principal preservation and guaranteed lifetime income, we can find that type of bucket. How would you feel if you could put your money in now? Let's say you're 60 and you're going to retire at 65. You could put your money there. If you have it in the 401k, you can actually roll it over to an IRA by law, and there's no tax on that, even if you're still working. But you have $1 million, we roll over. And that now becomes a plan where we're going to say, okay, you're going to retire in 5 years. We can defer for 5 years. How would you like to get a 10% guaranteed payout of your $1 million for as long as you live? And if you're married, for as long as your spouse lives, contractually guaranteed, even if you lived 120, even if the stock market crashes, up to a 10%, maybe depending on your age, a little bit higher payout. We can't get that anywhere. And it's just the best time period right now in the last 40 years to take advantage of these guarantees to make up for the falling interest rates in bank and to make up for a really volatile stock market.
Yeah. When you say 10%, what that means in your example, Dan, if they had $1 million, that's $100,000 a year in guaranteed lifetime income for both your single life and if you're married, your joint life, regardless of how often the stock market crashes, regardless of whether you make any money in the stock market. Even if you ran out of money within that contract, they're going to continue to pay you $100,000 a year, which is a 10% payout. That is not no place in the country can you get that type of payout, Dad, from any other financial instrument.
No, and I think the key there is to realize even if your worst fears happen, which is the stock market crashes, your other worst fears, you run out of assets. With this type of plan, your income will continue for as long as at least one of you is living, regardless of what happens. And I think just as importantly, Jim, you have 2 kids and a bunch of gaggle grandkids now. I got 2 kids, and we want the remaining assets that we have to be passed on to our beneficiaries. In this plan, you are able to pass on any remaining assets that are in your account when you both pass away to your beneficiaries. So you either get all the money or the beneficiaries get all the money, and you get the highest income payout rates you could ever get out of any asset. Isn't that what we all want? Think about it. If it's that simple, don't worry about what it is or how it works. Just imagine you put in money now, you defer it for 5 years, you get 10%, you get $100,000 guaranteed off of $1 million. If you die prematurely, whatever's left of the million is paid to your beneficiaries. If you lived 120, they're going to continue to pay the $100,000 for as long as you live. It's a pretty good setup.
Yeah, and you don't have to wait 5 years. You might want to start immediately. You might want to start in 3 years. Your distribution might be a little bit less as you start earlier, but you can pick the date that you want to start the income, and your income is guaranteed forever. And you mentioned earlier, Dan, the green bucket. And when we say the green bucket, what we're saying is that we divide money here into buckets when we're doing income planning. Bucket number 1, we call it the yellow bucket. That's money in cash, right? CDs, a bank account. You're going to have money in the yellow bucket. We put money in the red bucket. That's money in the market. We believe in the market long-term for some assets. Yes, you're going to take risk with those assets, but we think you need that bucket there. We'll design a plan to have enough money in that bucket for growth. And then we talk about the green bucket. The green bucket is what we're referring to right now. That's your income bucket, the guaranteed income.
No, and you know what? When you look at dividing money between those 3 buckets, which we'll talk about, if not later this show, next show, money liquid in the bank, money with guaranteed income, money with growth, it allows every person to have the opportunity to decide and control their money. Because aren't the 3 areas that we have to focus on, the 3 pillars for investing is liquidity, income on a dependable guaranteed basis, and then growth.
Yep.
Now, the problem is most people, and maybe you can explain this, how most people try to listen to their advisor, do it themselves. They design this diversified portfolio of stock funds or stocks or bond funds or bonds, maybe a teeny bit of cash, but they try to use that diversified portfolio to provide them liquidity, dependable income, and growth. And can we get all 3 things with a high probability it's going to work out if we have that type of diversified portfolio that's always used out there by advisors?
We don't believe so. We believe that if you have money just for growth, and that growth bucket's also going to be for liquidity if you need it, which you can, right? You have money in the market, you can take the money out anytime you want. But if the market is down, you're taking money out at a loss, right?
Yeah. So what happens if they have $1 million and they say, oh, it's liquid? I had an advisor argue this for a client the other day. They got $1 million that's liquid. The market goes down 50%. How much is liquid?
Well, 500,000.
Oh, right? Yeah. A lot of liquidity, I guess.
Exactly right. But these buckets are defined, right? They're very deliberate. We know exactly what we have to get out of these buckets. That's why we define it this way, Dan.
You're back with Dan and Jim in the Peak Financial Freedom Hour. And today we talked about just some generalities of what you need to focus on for successful retirement. And now, Jim, let's give them a roadmap. Let's give everyone listening a guide of what they need to do to have a successful retirement. And every one of our clients has been a good saver. If they're not a good saver, they don't need a planner.
Yep.
If they've saved less than $500,000, I wouldn't tell them to do anything other than keep it in the bank because they really can't risk it.
Yeah.
But clients that have saved $500,000, and our typical client has saved between $1 million and $10 million of assets. And those people need planning, because if a market loss decreases that, they're not going to probably have a high probability of a good retirement. So let's talk about all these people who've been saving, and they've done a great job, but no one's given them a plan for retirement and how they're going to distribute their income from the assets. So we're going to talk about then our 7 steps for secure retirement. And if you follow these 7 steps, every single American will increase their probability of success in retirement. Some of you just a little bit because you're already doing most of the things correctly. Some of you will double, triple, even quadruple your benefits of the probability of having a secure retirement just by following 7 simple steps. And we write about this in our books. You can download a copy of our book on our website for free, Mama's Secret Recipe for Retirement Success. It goes into the detail. It's a best-selling Amazon bestseller. We did that with Jack Canfield. He's the guy who wrote Chicken Soup for the Soul, sold over 500 million copies worldwide. You can also, if you want to meet to go over these 7 steps, just dial pound 250 on your cell phone, pound 250, and say the keyword money. We'll be glad to sit down with you and teach you these 7 steps and see, can they be applied to provide you a higher probability of retirement success? So let's look at number 1, Jim. Here are the 7 steps. Number 1 is put your entire plan in writing so you can feel free to spend your money without guilt or fear. And I think that's so important. I want you to talk about it, because when you talk about spending money to someone who's been a good saver, if you've saved $2 million by age 60, you've been a great saver. You've learned to be a great saver. The hardest thing for you to do is to now feel free to spend your money without guilt or fear. So explain that and what our job is to help them get over that so they can now feel a little bit more independent to do the things they planned.
Well, your mindset at that point, you the last 30 or 40 years, you've been working and you've been saving, and you were looking at growth in the portfolio. You were willing to take risk because you had a job, you had a paycheck, and you were making contributions to your retirement plan. You had a strict budget you lived upon to make sure that you would have enough money when you retired to get you through the last 20 or 30 years from retirement, and to build a retirement based on what you and your wife, if you're married, had planned. And you did all the right things. But now all of a sudden you had to figure out, okay, I'm at an age where I need to reposition my assets. I need to preserve those assets I saved for 40 years. And I need to figure out how to generate income of those assets to satisfy my budget requirements in my future. So you have to have a plan in place to do that. You just can't, I should say, we don't believe you can just throw the money in the market and hope it works out, because it may or may not work out. But if you have a sophisticated plan put in place, identifying exactly how to position those assets and making sure that those assets are going to achieve your goals, growth, income, and safety, you will feel a lot better in retirement, Dan.
Well, most people right now, when they come in for their first meeting, their free second opinion, the start of the planning process, we know they are literally so worried about their money. In the last 2 months, the people coming in have been so worried about their money multiple times, telling me literally how much anxiety they're having, how much they're freaked out, how much they're worrying, that they can't sleep, that it's affecting both of them. And if one of them's handling the money and really worried, then of course the spouse is going to be worried about the spouse worrying so much, knowing that probably affects their health, it affects their relationship, it affects how much money they feel like they can pull out. So we have to now look at the one single thing we know in our 60 years or plus in this industry that will almost always reduce how much you're worrying, maybe not eliminate, but reduce how much you're worrying, is having an actual plan in writing that shows where you're at right now, what you need to do to make modifications to get in a better position, what are the advantages of the new plan and the disadvantages of the new plan, and exactly how you should invest your assets to give you the highest probability that what you want to happen will happen. And if you had that, will that, if you think about it out there, will that reduce how much you worry about your money? We know it will, because right now we know you don't have that. In our time period in this industry, we've interviewed over 4,000 new potential clients to see if they were a fit for our firm and if we were a fit for them. And only 3 of them out of 4,000 had an actual written plan. Well, why do you think they were worried so much? And why do you think they came in to see us? It's because they didn't have a flipping written plan, Jim.
Yeah, and the problem with the industry is that there is no real planning done in this industry on a mass scale. what is done in our industry is they're telling people to invest money in the stock market and let it ride no matter what happens, and you'll end up with a high rate of return. That has been true for the last 2 years, right? We've been in a bull market for almost 2 years now. And if you just let it ride, that adage turned out to be true. But what goes up goes down. And when it goes down generally a lot faster than when it goes up. So you have to be in a position now, if you're getting close to retirement or in your retirement, you have to figure out how to preserve those assets from a large loss that will be coming. The market's at an all-time high. It's trading at 50 to 60% higher than it should be trading right now.
Actually,
double the historical average. Yes.
Historical average price to earnings is 17 since 1871, as calculated by Robert Shiller, Nobel Prize winner, that is an economist. 17 is the average since 1871 of price to earnings. Right now, we're almost at 37. And every time that happens, and it's only happened 5 times in history where we've been above 30, the stock market, whether it's NASDAQ, Dow, S&P, has gone down at some point after that happened by anywhere from 20% down to as much as an 89% loss. So if that's what happened every time, and we're sitting here now at one of the highest time periods we've ever been at price to earnings, what's it telling us?
Yeah, you got to be crazy not to heed that advice. You got to be nuts. And I know if you call your advisor on the phone or you go on the internet, they're going to tell you to stay in it, don't get out, no matter what happens. But folks, this is going to happen. It's just black and white.
We know it'll happen. We just don't know when.
We don't know when. I mean, maybe it'll happen in next month. It might be 2 years. We don't know what's going to happen. We don't have a crystal ball, but we do know how to build plans to make sure that we're mitigating the risk so that when it does happen, you don't have near as bad as the downfall you would have had if you hadn't repositioned your asset correctly.
Well, the whole goal, number one, is to make sure you can feel free to spend your money without guilt or fear. So what's the only way to do that? Well, if you're worrying about the market crashing, and if you're using your assets for income, you know it could run out. If you're worried that the income could run out because there's no guarantees, what must you do? You simply must take a portion of your assets, whatever portion we want to create income with, and make sure there will never, ever be a principal loss with those assets. Never, ever be a principal loss with those assets. Those same assets now have to provide you the highest level of income on the dependable and even guaranteed basis that will last for as long as you live. So if we can now go from worrying about the assets crashing and worrying about the income running out to knowing contractually guaranteed, we cannot lose any principal if the market crashes and we get income guaranteed for life, it answers that question. You're back with Dan and Jim, the Peak Financial Freedom Hour, and today we are talking about the 7 steps for secure retirement. We covered number 1, which is put your entire plan in writing so you can feel free to spend your money without guilt or fear. Number 2 is understanding the true risk you're taking right now and adjust the risk if it's too high so you can avoid all large market losses. Why? Well, everyone listening right now, you know intuitively, even if you don't feel like you know a lot about your money, you know if you suffer a large loss right before you retire during retirement, it's going to cause you some major economic pain and it's going to potentially derail your success in retirement. Because if we go through another 2001 and 2 and the market drops 54%, we go through another 2007, 8, 9, the market drops 53%, and you're invested like the market, which for most people is considered moderate, and you lose 50% of your assets, what's the chance you're going to have a successful retirement? It's going to be very low. So give me an example of people that just came in. They are 65, a couple last week, and they thought they were moderately allocated. And I said, what does that mean? Well, we can't lose that much. I said, okay, what do you think? They said, well, maybe up to 15%. We know it's more than your 5 to 10% rule, but 15%, and we were used to be comfortable with that. Now we want to be closer to 5%. I said, okay, so right there, we already know if you think you're at 15, we need to get to 5. We're going to have to make some major adjustments. We then ran using third-party research 2 different analysis of their portfolio. It didn't cost them any money as long as we had their assets, what they had the money and how much they had. We then can show them if we go through another time period where the market goes up, how much would they make, which is kind of good news. But if we go through another 08 financial crisis, how much they could lose. So in their case, in 2013, when the market went up 32%, their portfolio would have went up 30%, which was awesome. It was awesome. Mm-hmm. And I said, you'd be happy, right? They go, yeah, but we think you're going to give us some bad news. I said, well, that's the great news. The bad news is if we go through another 2008 financial crisis, you're going to lose 48.6% of your assets. So Do we want to be in that position to make a 30% gain in the maximum upside and then lose 48.6% in the downside? And I'm going to say the answer is no, especially when they thought they just had 15% risk. And in reality, they don't want to take any more than 5% risk.
You know, every single person listening right now, Dan, is saying the same thing. If they're talking to themselves or talking to their spouse, they're saying, well, we probably only have 10 or 15% risk. My broker told me that I'm in a position so I won't lose a lot of money.
Yeah,
if the
I have a
market drops.
60% stock fund portfolio and a 40% bond portfolio, which is perfect for a retiree.
Yeah, and that's safe. Let me tell you, folks, on that 60% stock portfolio and the 40% bond portfolio that Dan just described, which is a typical portfolio people from 60 to 75 have if you have a brokerage account, or if you have an advisor. That means that the market goes down by 53%, and it's dropped over 50% twice in the last 24 years. That means you're going to lose about 38 to 40% of your money. That's the facts, folks. We have this research here. Now, why you say, didn't my broker tell me that? Or why didn't my advisor tell me that? Well, if he told you that, guess what? You wouldn't have invested with him. So he's not going to tell you that.
Or you would have yanked the money out.
Yeah.
And if this starts to resonate, do not allow yourself to go back in the black hole thinking everything's okay before you find out everything's okay. You can call in at pound 250 and say the keyword money, pound 250 and say the keyword money. And here's what we'll do. We will give you a free, no obligation risk assessment. We will calculate out, and it's pretty cool to see on our screens. We will calculate out how much when the market goes up you would make, so you'll know the good news, and how much you better be prepared to lose if the market goes down. And wouldn't you like to know that data right now for free without any obligation? No cost, no obligation. We'll give you the data. If you want us to give you more data afterwards, we will. If not, we'll shake your hand and say, it's nice to meet your friend. And you go on. And people say, why do you do it like that, Dan and Jim? It's because then we have a great name out there in the community, because we always will give you education, information, advice without any pressure or any obligation. You have to work with us. So please call in. Let us give you a free risk assessment. And you have to think, if you don't have much money saved, you really don't got to worry about risk, because you shouldn't be taking risk. But if you have $1 million, $2 million, $3 million, $4 million saved that you've accumulated, you worked your butt off to get that, and now you're sitting getting ready to retire, you're in retirement, and you hope you're not taking too much risk, but you kind of think you were, because you remember in 2022 you lost 20% or more. You need to have a risk assessment done to show you in writing exactly how much risk you're taking, and it won't scare you, it'll liberate you, because wouldn't finding out how much risk you're taking now, whether it's high or low, allow you to make the best decisions moving forward for the rest of your retirement life?
Yeah, this is such a great offer that every single person listening should take advantage of. It's going to take a little bit of time to come in our office. Let us do the risk analysis for you. We're using outside third-party research companies to do this. They're tracking every trade on every major index since 2000. They'll just take your portfolio you have right now. We'll strip off your name. We'll strip off your account numbers, and they will enter it into their database. And that database will take your portfolio, go back to 2007, 8, and 9. It'll show you what you would have done then. And then their algorithm will calculate what you're going to lose or gain in the next market upturn or downturn. Isn't that really good data to have? And I can promise you, we've never done this ever where a client wasn't shocked. They weren't shocked. Because if you have a 60-40 portfolio, you're going to have a risk factor of 38.53%. That means that if the market goes down by 50, you're going to lose about 38% of your money. So isn't that valuable information to know right now, so you can reposition those assets to make sure that you do not lose 38.5% of your money?
Well, to make it pinpointed to you right now, if you're listening, let's pretend like you're those clients that came in and you thought you had 50% risk. So in your $2 million portfolio, you thought you could lose 300,000. And based on that, you decided you really didn't want to have that type of risk. You only wanted 5% risk. So on the $2 million portfolio, you wanted to reduce your potential loss in a market catastrophe from 300 down to 100,000. Mm-hmm. Right there, it means you need to take action. Something needs to be done. But what if you came in and you had 48.6% risk? And that means on your $2 million, you're going to lose almost $1 million. And that's actuality, that's reality. That's telling you even more so, you better make some changes to the portfolio so that you can feel comfortable that nothing's bad is going to happen going forward. And when people come in, the average amount of risk ranges from, typically the low is 30% and the high is 55%. So if they're in those ranges, if you're in those ranges, which there's a high probability you are, you need to make some changes to make sure that that's not going to derail your retirement. Hi, Dan Ahmad and Jim Files here. You're back with the Peak Financial Freedom Hour. Today we are talking about the 7 steps for a secure retirement. Let's jump on to number 3. And number 3 is probably the biggest one. Eliminate your fear of running out of money by creating dependable monthly income paychecks that are guaranteed to last for as long as you live. We find that to be the number one key aspect of making people feel comfortable, because if paychecks come in for as long as we live, we know now we have the income on a monthly basis to pay for all the things we want and need. And we really want you to have excess monthly income. We want you to have more income coming in than your budget every month so you can save it and have it available to spend in the future. And people don't know how to do this, because if you have a big pension, which when people come in now, only about 1 out of 20 people have significant pensions, 19 out of 20 don't. So it comes down to, how are you going to now create pension type income that will replace your paychecks? And you can do this. And right now, with the market where it is as far as income payout rates, there's some of the highest rates we've ever seen in the last 40 years. Give you an example. I had clients come in, they're 60, they're going to retire at 65. We put them into one of the plans that will guarantee their income at 65 once they retire, and they're going to get 10% of their original $1 million paid out for as long as they live. So imagine they have $1 million of their $3 million portfolio we allocate toward income, and just that $1 million is going to give them $100,000 of a year of income guaranteed for as long as they live once they retire 5 years down the road. A 10% payout of the original million.
And what's really cool, because of the way we divide money up, that's just one of the 3 buckets where we'll place money, right? The other $2 million can be aggressive. It can be in the market. But wouldn't it be nice to allocate your assets so that your income needs are taken care of, so that when the market does go down, you're not panicked, that you can continue to live your lifestyle? Because in retirement, you get 2 choices. It's real simple on income. Number 1, you can put all your money in the market, or most of the money in the market, and you hope you can take out enough money to live on. When the market goes up, you probably are refrain from taking out too much, because you're saying to yourself, what if the market goes down? I have to be prepared. Or if the market's down, you say, I can't take out any money or very little money, because what if it keeps on going down, and how long will it take to recover? That's called maybe income. It might be there and it might not be there. Or alternatively, you can allocate some of your assets, not all of them, but just some of the assets, for guaranteed income products, so that when the market goes up or down, it doesn't really matter, because your income needs are taken care of. And when the market goes up and down, you can hang in there and ride it out as much as you want, because you have enough income to satisfy your income needs.
Well, another thing we use this for will be for spouse planning as a surviving spouse. Had clients come in 2 weeks ago, and they have military pensions. He has military pensions about $150,000. If he's gone, it's going to drop down to about $30,000 because of the options they chose. So that's going to leave the spouse in a world of hurt. So we're going to use this same opportunity we're talking about to guarantee her an extra $100,000 of income if he's gone, and he's 65. So we're saying, okay, 10 years or later down the road, she'll, on $1 million, we'll probably get anywhere from $100,000 to $150,000 of guaranteed lifetime income for her, depending on when he passes away. And they don't need that extra money now. So every year he lives, the income is guaranteed to increase more, so it protects her against inflation, etc.
You know, most advisors don't do what they tell you to do. Dan and I do for our own personal money, for our own family money, the same thing we're telling you to do. We're doing these guaranteed products because we too look at the data. We know the market's going to go up and down for the rest of our lives. And do we want to rely on our income from a market that's with an asset's going up and down? So we're allocating money just like we're telling you to allocate money, to make sure that you are safely taken care of for the rest of your life.
Exactly. So I think that's one nice thing. You can trust that whatever we advise our clients to do, we are doing the exact same thing. Let's look at number 4 real quick. Number 4 in the 7 steps is to protect and grow your assets. Don't lose what you work so hard for, meaning don't take excessive risk. In every single client we meet with, that's what they want to do. They want to protect the assets against the large losses. They still want to grow them, but they just don't want to lose anything that they work so hard for to accumulate. Because what if you have $3 million? And if you suffer a 10% loss, doesn't sound that bad. 10%, ooh, that's not going to kill us. That's a $300,000 loss. And I asked those people, how long did it take you to save $300,000? And they said, no, 5, 6, 7, 8, 10 years. I said, exactly. So do you really want to be in that position to lose that big of a chunk of the money? Number 5 is to use multiple conservative asset strategies to reduce risk and volatility. Jim, you already covered that because you talked about our 3 buckets. We use a gold bucket, which is our liquid bank bucket, a green bucket, which is our principal protection and guaranteed lifetime income bucket, and we use our red bucket, which is for growth. And you really need all 3 buckets to design a proper plan. Number 6 is uncovering the total fees you pay, both direct and indirect, the fees you don't see. And why don't you end the show with number 7? How much can you potentially leave to your beneficiaries after everything's said and done? You've lived a wonderful retirement and you're gone, and now the remaining assets pass to the beneficiaries.
The only way you can leave a lot of money to your beneficiaries is to make sure they don't lose a lot of money during your lifetime, right? And unless you divide your money up, like we just mentioned, into 3 buckets: money in the liquid bucket, safe and secure, that's cash in the bank; money in the guaranteed bucket, safe and secure, that's income for the rest of your life. It will have no market fluctuation. And number 3, money in the market, that is for growth. It's going to have fluctuation. It is going to go up and down. But if you're not drawing money out of an asset class that's going down, and you drain that, like with money in the market, and you're using your income bucket, which is we call the green bucket, the middle bucket I just mentioned, and you're drawing guaranteed income off that bucket, you have an opportunity to leave money to your beneficiaries, in some cases significant money to your beneficiaries, because you're not using assets from a money in the market while the assets are going down. And that gives you the ability to live your lifestyle the way you want to live it, making sure that you have enough income to do all the things that you want to do for the rest of your life, and also leave money to your beneficiaries.
You're back with Dan and Jim, the Peak Financial Freedom Hour. And today we are talking about avoiding common money mistakes. And I think it's one of the biggest fears we have, because most people don't understand a lot about their money or finances. And we are so afraid that we're going to make a mistake that not just will be a small mistake we can make up for, but will literally ruin our retirement. And we're here to tell you there are mistakes you can make that would ruin your retirement. We talked about how to avoid some of these things. We talked about not having an actual plan in writing, ignoring stock market warning signs. We talked about incurring a large loss right before, during retirement. So all those things are problems. Well, how about this one? One of the problems I see in retirement, you see in retirement, is that people have regrets that they haven't used their money for the things they want at an early enough age to be able to have fun and benefit from it.
We see that all the time. And we also see the question that comes up all the time, whereby people say, well, listen, I've entered retirement. I'm in my early 60s or mid 60s, and I want income now. I want income to do the things I want to do. So those people are proactive. But the other people that have been reactive have not positioned themselves correctly. Now they're in their 70s and they weren't able to do the things they wanted to do because they didn't have enough income. They're worried about the stock market. They're worried about losses. They're worried about inflation. They're worried about all these things because they didn't have a plan in place to solve those issues before they started investing those monies, Dan.
No, definitely. Well, let's look at then this specific portion of this concept, and that is people are told, or you think, and you're either told by your advisor, your CPA, you should defer taking distributions from your IRA until age 73. So let's say you're 65 now or 60, and you talk to your CPA, they say, oh, because of taxes, wait until 73 when you have to take out your required minimum distributions from your IRA. Because of taxes, you'll pay less taxes between now and 73, which is true. Or your advisor says, oh, wait until 73 because that's when you have to take money out of your IRAs. Well, at that point, we think the advisor is telling you to do that because they don't want the value to go down, because then they make less fees. But in reality, if you defer from age, let's say 60 to 73, 13 years, and you have $1 million now, you might have $2 million or more then, just with a small growth rate. Well, does it make sense to defer your IRA distributions now to have more money in there when they force you to take distributions out? Think about that. Do you really want to have more money in there when they force you to take distributions out? And do you think 13 years down the road, tax rates will be lower or higher? I think there's a better probability tax rates will be higher. So we look at that financially, but we also look at it emotionally. At 60 or 65, can you spend the money easier than when you're 73? And the answer is yes, because you're going to be healthier. You're going to want to do these things. Both of you are around now. Who knows if one of you will be gone later? So you have to do the things now. The key is going to be to do what we call a levelization, levelize the income out of your IRA for a longer time period, because then you'll be taking a smaller amount out over a longer time period. And then, Jim, does that then calculate out to higher taxes or lower taxes?
It always calculates out as lower taxes, right? Because you're equalizing those payments over a longer period of time and upfront. And a lot of people, Dan, when we say required minimum distributions, they may not quite understand that. What that means is if you have a 401k or a 403b or any type of retirement plan, an IRA, the government says that when you turn 73, they are mandating that you take out a certain percentage every single year until you die. And if there's any money left, the children or the beneficiaries have to take that over a 10-year period, which means every single year they're mandating by law that you have to take out more and more and more and more money. So Dan's a tax expert here. We have tax counseling here in our office. We have an enrolled agent. Besides Dan was an enrolled agent for over 30 years. We can provide tax advice, whereas most brokerage companies and advisors don't have that ability. And unless you truly understand this, you will end up paying more taxes.
Well, and I think that's what people get lulled into, that just a simple thing like deferring will reduce taxes. Well, it will. From 60 to 73 or 65 to 73, you will not be taking distributions. You won't pay taxes. But the issue is, what tax rate are you going to pay anyway? And when you look at the tax rate you're going to pay during retirement, it's not going to be as much as we think. Why? Well, when you work, if you make $200,000, let's say you make $18,000 a month of gross income, you usually net about half of that, because you're paying into Social Security, you're contributing your maximum to 401ks, 457 or 403bs, you're paying federal and state tax. All that ends up taking away about half your money. So you assume at retirement, you're still going to only get about half of your gross income. It's not going to work that way. Let's assume you have $180,000 of gross income at retirement. So $15,000 a month, which is less than what you were making before at $18,000 a month. On your $15,000 a month, you're going to pay about 20% in taxes. So that means you're going to pay about $3,000 in taxes for federal and state. And you're going to be left with $12,000 in net income while you're retired on $15,000 of gross income versus $9,000 of income before. So can you live a happier retirement on $12,000 than $9,000?
Of course you can. But again, unless you do tax planning, unless you do income planning, unless you're dealing with a firm that can actually do these calculations and actually provide the advice, you run naked out there, right? You worry. But if you put a plan together, Dan, and we see this every single day with people that come in call us from the radio show or call us from our TV show, they're astounded when they actually put these numbers in writing, and they can actually see in many, if not most cases, they're going to have more net income after tax when they're retired if they position these assets correctly.
For more information about Peak Financial Freedom Group or to schedule a consultation, just go to our website, peakfin.com. That's peakfin.com. And thanks for watching.